Good evening, everyone, and it's a pleasure to have you all join us today for a webinar on mid and small caps driving India's $5 trillion pathway. I am Arvind Ravindran from PMS Bazaar, your host for today. As India charts its ambitious journey towards becoming a $5 trillion economy, mid and small cap companies are increasingly being seen as the hidden engines of this transformation. These are the agile, innovation driven, and fast growing businesses that are playing a pivotal role in shaping India's next phase of economic growth. In today's session, we will uncover data driven insights, emerging trends, strategies to manage portfolio volatility, and also explore portfolio building approaches. For that, we have our special guest, Mr. Achin Goel, Fund Manager at Bonanza. Mr. Achin oversees portfolio management services across strategies, managing over 300 crores for high net worth individuals. With over 14 years of experience in senior roles across capital markets, including personal finance, portfolio management, wealth management, algorithmic trading, broking services, insurance, and mutual funds, he brings a wealth of expertise to his role. Mr. Goel holds a graduate and postgraduate degree from ICT and Eastern Michigan University, respectively, and he is a CFA charter holder, certified financial planner, and also as a PGDRM from the Institute of Insurance and Risk Management. Welcome, sir.
Thank you. Thank you, Arvind.
With that, let's start today's session. Over to you, sir. You can go ahead with your presentation.
Very good evening, everyone. And it's a great pleasure and an honor to be, in between all of you. And I welcome you all. And at the same time, thank you for taking your precious time for this session. We are talking about, forget that. I mean, imagine an India wherein, we have all the vehicles which are driven by EV. Imagine India wherein we are exporting semiconductor chips. Imagine India wherein we are exporting, defense warheads or other thing, right? That is the India probably you will think it's an opportunity today or maybe a dream. But when it comes to small cap and mid cap, that's exactly what we look at. We look at the conviction rather than the comfort. Recently only, you saw a report that UPI transactions, highest UPI transactions were recorded around, I think, 640 million transactions a day. Now, with that number of transactions, practically India surpassed transactions which are done by Visa. And 1st and 2nd of June, our average was actually higher. Now, if this would have been said 9 years ago when UPI transactions started, I don't think anyone would have thought that we would be doing so many digital transactions in India. Today, as we talk, we are at the cusp of transformation. With $4.2 trillion economy, we are definitely poised to be $5 trillion economy next 2 years, right? But in this transformation, who is going to play the major role? Is it the giants, or will it be small cap and mid cap? And that's the question which always baffles us. Sometimes we look at small cap and mid cap as, the segment which will give us alpha returns much more than large cap. By nature of risk, definitely they will. But why will they drive the economy? See, when you grow from 4 trillion to 5 trillion, our challenges in the economy will be as per $5 trillion economy. When you go from 5 trillion to 7 trillion, our challenges as the economy will be for $7 trillion economy. And these challenges will need solution. These disruptions, that is what small cap and mid cap segment has been fueling all this while. Classic example is Zomato or Swiggy, for example, right? Now, these companies have created disruptions by bringing in a solution that was required to grow the economy. UPI payment, right? All these disruptions are the one which are leading the change. Does it mean that large cap cannot do that? Definitely they can do that, and they are doing it. But the pace, the agility, the adaptability which is required, that is much more in small and mid cap compared to large cap. So when we start looking small cap and mid cap as the solution to the growing economy, our perspective change. That means we are trying to find or invest in those companies which can solve the problems that exist today. Most of the small cap companies have become the large cap, as we know. I mean, Infosys, VST Tillers, Bajaj Finance. I mean, we all know the growth stories. So, in this session today, that's what we are trying to touch upon with data-driven insights. How do we work around with volatility? What are the emerging sectors and trends as per Bonanza? Some growth stories, and then how exactly we construct the portfolio. See, eventually, I always feel whatever is the story, it has to reflect into numbers, it has to reflect into some meaningful outcome. And that is what we will be discussing in today's session. In terms of GDP growth, we all know that at this point of time, we are around $4.2 trillion economy. And market cap to GDP ratio at this point of time is around 120%. As you can see on the screen, we are roughly around $5 trillion economy in terms of market capitalization. And small cap and mid cap as a segment contributes nearly 38%. That means we are $1.9 trillion in small and mid and roughly around $3.1 trillion in large cap. 2027, our GDP is expected to be $5.2 trillion with an 11% nominal GDP growth. And our market cap, keeping the ratio at 1.2 only, it will be roughly around $6.2 trillion. Now, when we look at the small cap and mid cap contribution, it will be roughly around $2.55 trillion. Now, this CAGR growth of small and mid cap alone will be close to 16%. So, what has changed? I have done two things. Number one, the contribution of small cap has increased from 38% to 40%, mere 3%. And on the next slide, you will see why it is 3% growth. And it is also emerging from the current trends that we'll be discussing in due course of time. Now, let's look at the universe, right? As per MFI, only top 100 are large cap, rest all are mid cap and small cap. So when we look at the historical trends, this is the small cap and mid cap contribution as a percentage of total market cap. That's a very interesting trend. You see that in the early 2000s, we were talking about maybe around 17-18% average. Now it has reached to around 38% over last 2-3 years. Now with the growth that is coming into small cap, mid cap, notably in 3 years, definitely we'll be having 2 to 3% more alpha contribution in the small cap, mid cap. And we look at the returns. It's a no-brainer that with a small cap, mid cap, with a high risk that we'll be also touching upon, the returns are close to 35% CAGR in last 5 years. It will have a base effect of COVID also, and even inception. We talk about maybe more than 2 decades of small cap, more than a decade of small cap, more than 2 decades of mid cap. You are talking about CAGR returns of 15 to 21% at the index level. And these are just 100 small cap companies out of thousands of small cap companies we are talking about. Like I said, small cap and mid cap are trying to solve the problems for the economy, and this growth is primarily into 2-tier and 3-tier cities. Now, when we go to tier 2 and tier 3 cities, contribution from microfinancing becomes very important. That's why you see there's huge surge and there's a huge leg of growth for the microfinance companies. Lot of infrastructure, lot of bandwidth, lot of labor, lot of tech which is required is available in tier 2 and tier 3 cities. The sector diversification, the new solutions are not coming from the traditional sectors. New sectors are required. New sectors are emerging. New thought process is emerging. Right? So that's why small cap and mid cap are more necessary today than ever as we venture into new growth. Then it comes with a risk. Credit bottlenecks, and thanks to AIF, the private credit growth is picking up at a very fast pace. Probably, that we can't imagine, not only in India, across the globe. Private credit is, the next thing. to be, and that is fueling the growth in small cap and mid cap. Market fragmentation is another challenge. It remains fragmented, and definitely, there's an impact on the small cap and mid cap. Tough times like COVID has wiped off a lot of startups during during 2021, 22. So it's not easy also. There's a rosy picture, at the same time, there's a difficult side to it. But small cap and mid cap, I mean, when I look at the data, I'm really intrigued and mesmerized. We are talking about 1 lakh plus startup ecosystem registered. And you understand one thing, that these startups, whosoever is doing the startup is trying to solve a problem. Even if I presume, there's a overlap, we are talking about roughly 10,000 different problems that are being worked about by the startup ecosystem today for fueling the economy. Unicorn creation, more than 100 plus unicorns with a total value of $350 billion plus dollars. IPO pipeline, we have all seen the kind of IPOs we are getting. PLI scheme, Atmanirbhar Bharat, ease of business, startup India, everything, from government policy to the ground level is hinting towards a transformational inflection point we are at for the small cap and mid cap growth story. But with this, definitely, like I said, comes the market volatility. That are we making our portfolios too volatile? Definitely, it looks very rosy that we will be investing to small cap and mid cap, and volatility is an inherent part. But when you actually deep dive into that, I showcased you earlier the returns of 30-35% CAGR for 5 years, and since inception returns of 21% for small cap index. Now these are risk adjusted returns ratios practically. So when you look at the ratio of returns to standard deviation, you will find in 5 years, for every risk, 1 unit of risk that has been taken by a mid cap index, 1.9 units of returns have been delivered. For every unit of risk that has been taken by a small cap index, 1.76 unit of returns have been delivered, compared to large cap, which is Nifty 50, where for every unit of risk, it's 1.5 unit of return. Even since inception, if you look, now when I'm talking about the mid cap index inception, you're talking about 2 decades. The large cap ratio of risk to reward is 0.5. That means for every unit of risk taken, I have delivered only 0.5% returns. But index, on the other hand, for every unit of risk taken, has delivered 1 unit of return. So there is an incremental risk, there is an incremental standard deviation, but at the same time, the rewards are definitely higher. But does it suit everyone? Probably no. Do we understand this? Probably yes. Do we act upon it? And that is where I feel most of the things goes for a toss. It's a void. Most of us understand volatility is a concern. Most of us understand that we need to take a disciplinary approach to investment. Most of us knows that when markets are falling, we have to come in cash, maybe book losses. We have to not let our emotions drive the decisions. All these things we know, we understand. But somewhere, as an individual human being, we are unable to act upon it, or we fail to act upon it, and that is where behavioral finance takes over it. But when a professional is managing, many of these things, I would not say most of these things, are somehow addressed to a certain extent. And at Bonanza, definitely we work on all these aspects to make sure that in the volatile times, in the turbulent times, we actually work upon and make sure that we are coming in cash in the cash when the markets are falling, and when the markets are rebounding, we re-enter. And that is a process, and it is process because of our journey of more than 2 decades of managing the portfolios. With that, we come to the Bonanza strategy of how do we build in small cap and mid cap growth story. Like I said, mid cap and small cap are the drivers for the next growth of Indian economy. We can't deny that. We can ignore it. That will be our ignorance. And our niche has been primarily into small cap and mid cap, and we have been participating in this growth story, like I said, in the form of PMS for a long time now. We align our objectives with the India's growth, and we keep on doing it with a good track record while managing the volatility. We will understand few sectors as per us where we feel there's a huge momentum and a growth story which is unfolding. At this point of time, if you ask me, which are the sectors that my research team, my fund management team, or I'm tracking, so these will be 5 on top of my list: renewable energy, electric vehicle, infra, railways, and defense. This is one facet of the portfolio management wherein we are having a top-down approach. But in the portfolio construct, it's a combination of both top-down as well as bottom-up. The stock ideas can come from both. It can be you identify the sector, you are bullish on a sector, and then you identify the stock which has a moat. Or it can be a stock which may not be in any of these sectors but still has a moat or a growth story turning. In today's session, we will probably take up 2 sectors quickly, which I feel needs notable mention, and especially I believe after today's morning, news of Israel and Iran war, defense again takes a priority. We all know the focus on defense for last 4-5 years. We have a huge roadmap laid out. Within defense, we understand Hindustan Aeronautics is a big name, but today everyone knows HAL. Maybe 5-6 years ago, people were not talking much about the HAL, GRSE, Cochin Shipyard, and other stocks. It's also ambition of government of Atmanirbhar Bharat, and last few unpleasant exchanges between certain countries has made one realization known to everyone, that whenever any war-like situation is going to happen or any war will happen, most probably the countries which are into the direct conflict will only be participating. Other countries may be supporting from outside, which means all the countries need to be self-reliant. Be it 4 instances which has happened in the past, we have seen that. That means that all the countries have to be self-reliant in terms of having drones, having aerial fights, having naval system. And another thing which has happened is today the wars are not fought on ground. They are either fought on air or on sea. We have to protect our sea as well. So the defense is the most critical thing today that we talk about, and it will remain so for next decade. With the growing geopolitical tension, with the growing ambition of other countries of maybe holding on to some other country's land, these things are more prevalent today than ever. And definitely with defense comes the defense tech. You have drones. I mean, India-Pakistan war, Sindoor operation, we all know that drones play such a critical role. We are just $4.2 billion today, and it's expected to be $23 billion by 2030. We are talking about 4 to 5 times growth in drone alone. Right? So this is the defense sector growth story that we are talking about. And within defense sector, one of the stock which is primarily into shipbuilding and maintenance is Cochin Shipyard. With a 5x order book and the revenue visibility even beyond that, it is something which definitely has a place in my portfolio. They are also in advanced talk with South Korea, Hyundai, and setting up a 10,000 crore mega shipyard in Tamil Nadu. So a lot of developments are happening in this. I'll just pause for 2 seconds on this to go through this. But yes, when it comes to defense, there are many names, there are notable names, but one of the stock that will be on my list will be Cochin Shipyard. And some of the reasons, are in this slide, which become little clearer, wherein you are talking about revenue growth year on year of 24% on 25 compared to 24. Their shipbuilding contributes nearly 60% of the revenue. But when it comes to margins, shipbuilding has a lower margins. We are talking about 37-38% of margin. Major contribution of the revenue comes from the ship repair. So as soon as the size of ship repair will increase, the profitability is going to increase exponentially, because the margin contributions from ship repair is higher. And as the new production increases, the repairing volume keeps on growing. Right? So we are expecting a huge growth in this Cochin Shipyard, and we have positive view on that. Another sector that we are bullish on is infrastructure and construction. When you talk about Atmanirbhar Bharat, Viksit Bharat. Infrastructure is the key enabler to any of these things. So with the mission Viksit Bharat 2047 and a 11.2 crore outlay, one cannot ignore the infrastructure and construction as a segment. With a $5 trillion economy, we are expecting a huge growth in this segment and at multiple levels. Smart cities are being constructed, ambitious plan of 200 plus smart cities, and we see those development happening. At one point of time in India, we'll say there are a lot of talks but no action. Today, I see at ground level that action is happening, and not only me. I believe all of us are part of this growth story. One of the notable stock again within this segment is KEC Infrastructure, KEC International, which is primarily known as in power and transmission. But let me tell all of you that today the revenue from power and transmission is only close to 42%, and new business that they have created is mainly into railways, civil, lane pipelines. It's a wonderful stock, and the kind of business and the order book it has, it definitely warrants everyone's attention. Another beauty of this KEC International is the revenue diversification. It is present, I believe, in mostly 110 plus countries, the revenue contribution. And these are the major countries in which the segment wise revenue comes. And again, like I said, order book visibility is phenomenal. So one of the stock that should be in one's radar when you talk about infra and construction would be KEC International. So we know about the sector, we know about the stock, but how do you create the winning portfolio? What is it that will drive your portfolio's CAGR to 25, 30, 35% CAGR? And that is a question that we all have. And that's the problem. Like I said, when you grow as an economy, we are trying to solve the problem. And one of the problem as the investors is the returns. Let me take you in next few minutes through the Bonanza's way. And every portfolio manager, every professional have their own unique point. Now, our process starts with stock identification, wherein we identify the stock, but this contributes only 40% to the returns. The major question lies when to buy, how much to buy. Let's say you want to buy KC. Is it the right time to buy? Should I wait? Even when you decide on the time, how much to buy? How much percentage should it be part of your portfolio? When to exit? Do you want to validate your thesis again? And is there any alternate substitute? So today in this seminar or webinar, we will touch upon two things and most critical part, getting in and getting out. So stock identification and when to exit. These are the two processes of Bonanza that we'll discuss today. It will give some idea how it is being managed. And before that also just one quick thing that these are the 5 unique points I always say at Bonanza, that we are very agile. We are agile in investment and booking losses, right blend of strategies, and compartmentalization of research and fund management, which would be our USP when it comes to other portfolio managers. So stock identification. We look at multiple data like everyone. We look at DII flow, we look at FI's flow, we check all the fundamentals. I believe everyone look at the fundamentals, that's the basic, right? But we also have a proprietary algo screener. Stocks come from both, and then we go to the manual screening process. Just to give you a glimpse of FII flow and DII flow data, this is a fortnightly FII flow. If you will look here, there's a huge inflow of funds into the capital goods. There has been a positive trend on chemical sector, financial sector, services, and telecommunication. So it will give you some idea where to look at. Again, this is one of the things. Please don't take me this that these are the things we only look at. I'm just giving you a glimpse of the work that goes in Bonanza. This is a sector-wise data for mutual funds. You have business services. If you will see, the number of shares have been constantly increasing. So it is something definitely that catches my attention. That which stocks are there into the business services? I have to look at them. Aviation, retailing, FMCG. At the same time, I may be cautious on chemicals as per this, hospitality as per this, plastic product as per this. This is one of the indicators, not again a decisive parameter. Then post this comes the other part, which is our proprietary algo screener. I'll just take 1-2 minutes to take you through our other investment processes that we use. And it is, like I said, it gives us a good insight into our portfolios, and also it allows us to screen into new stocks. So we have the 5F and 1T approach, in which, as you can see, we rate all the stocks on a scale of 30, which is, I'm not sure if you can see that, but I'll just give you a glimpse. So this is a quality, holding, growth, valuation, technical, and financial. So these are the 6 parameters on which we evaluate internally all the stocks on a scale of 30. And it's the current number as well as how the numbers are growing. See, whenever you look at the current number. But in our tool, we have built in how these numbers have been helping, from the past. For example, look at 𝐤𝐫 Realty. As per our tool propriety, its ranking was 21, and now it has come to 25 over 3 months. That means all the parameters have been increasing over last 5 months, 4 months. And it gives me confidence that yes, we are in the right direction. Himadri's specialty was from 20, it has come down to 28, it has come up to 23. Right, so this is the portfolio tool that we have in-house. So we have data-driven approach, we have our screeners, and then comes the manual screening part, which still contributes 25% to the selection of the stocks and the portfolio. We can just take up any stock, for example, let's talk about maybe high-tech pipes. It just filters out here. And let's see, how does it help us in the real time also. So if I have to look at the high-tech pipe, we will see that the score is 17 to 16. It is not very comfortable to me. If I click on the score of 16, now it's not something that I will reject this stock. Right, so there's a concern on the quality. I will go recheck, revalidate. So 2 parameters probably I'll look if I still want to invest into this stock. That will be quality and valuation. So it's like a quick X-ray that we have, and we have been using this for almost 2.5 years in our screening tools. Now, another part I would like to highlight when it comes to portfolio management. Yes, so businesses. So I was talking about the multi-bagger stocks, and then I come to the other part. So after the monthly data of mutual funds, the other side that we use is the algorithmic screening. And then we come to the multi-bagger stocks that we have in our portfolios that we are holding. So these are some of the stocks for last 1-2 years. We are still holding HAL that I have not mentioned. There are more, to the growth story. We have Reliance Infra also. But again, Wockhardt, we all know the story of Zenith and the oncology drugs approval. We all know Manappuram Finance recently came about, the acquisition by Bain, but we have been holding since 2011. Data patterns, again, a defense, E2E network into, cloud computing. So these are some of the stocks, recent ones, less than a year growth stories, what I mentioned here. Third part of the portfolio management, I said booking losses and exiting, when to exit and add. So we are very aggressive when it comes to booking losses, and we don't regret. See, one of the reasons I feel Bonanza is differentiated and our team works hard is to make sure that we don't hold on to losers. I'll take 3 examples. In one of the strategies, we have a clear mandate of exiting with 30% loss, because we don't know how further fall will the stock have. So this is 𝐄𝐞𝐫𝐭 Telematics. We entered at a level of 1930 on December 10. There were reasons, there were orders, there were everything. But then stock corrected, correction by more than 30% as per our defined loss for that particular stock. And even to now, so from February until June, we are still at a level of 1000. So we exited at 1300 levels. So this is a policy that we definitely follow, that 30% give or take we would exit in the actively managed strategy. Another stock we'll talk about is KEI Industries. We entered in the month of Feb at a level of 3800. Cable industry and everything was booming, but suddenly the news came about the ultra tech entering into the stock, and we had a 20% drop the very next day. Definitely it can be wrong entry timing, whatever you can call, that is part of the process. We can't ignore it, we can't be immune to it. And again, at a level of 2700, we exited. Now it is in the hindsight today that the stock is 3,700. But if we look at our exit level of 2,700, the stock fell further to nearly 2,400 levels. So from there also the stock fell by 10 to 15%. Point I'm trying to make here is that our logics or our stock exit may be right or wrong, but there's a process that we follow. When you're talking about, when we talk about the portfolio creation, when we talk about the wealth creation, we have to make sure that discipline is there, and whatever policies and processes you have, they are properly backtested, they are implemented, and they are followed. And with these three examples, I just wanted to highlight our other part also, like with DOMS in industry, third one. We entered at 2,600 level. Again, it's a monopoly item into, I would not say monopoly, but yes, a market leader into stationery items for kids and everything. And every time it comes up, it goes down. So for me, this was not a 30% loss, but a opportunity loss. Like I said, 20 years of experience has taught us many things. Growth story is there. Yes, DOMS has a growth story. Will it give me good return in the future? Definitely it can. But for me, from January to June, it's an opportunity loss because somewhere it is unable to break that barrier. So it's better to exit and get into a stock which can probably deliver me better returns. So like I said about the entry, we have the manual process of screening. Once the data has corroborated, once the algos have corroborated, definitely there are some manual ideas also that come. And we have discussed about our exit policies, which are missing in many of the, I would say, institutions. And exit is more important than entry as per us. So I hope you have got a glimpse of the way we manage products at Bonanza. And I'll just quickly also take you to the returns part. Edge is a strategy in which we invest into opportunities which can be multi-bagger over a period of time. Results and returns will be disproportionate to market. Like I said, small cap and mid cap industries, wherein we expect some catalytic event to trigger. It can trigger at any point of time, right? It may take a year's time or 2 years time. We have been invested in our power and our infra for more than a year, but trigger only happened, last 1 month, 2 months when we saw 60% plus growth, right? So 40% CAGR over last 5 years is what we have delivered in Edge. Again, like I said, past performance is not the guarantee. It's a disclaimer we all do. By no way it is a means that we are talking about these are returns are achievable. I don't even say that. But point, what I mentioned here is there's a process, there's a focus. Aegis is a more actively managed portfolio. It has completed 3 years. And this product we launched in 2022, keeping in mind the need of the investors that with every, month or 6 months, we want to be at par or ahead of the market. So yes, there have been 3 months, 6 months in which we were underperformed, but on a year scale or a 2 years, 3 year scale, definitely this strategy has resulted into, better returns in the market. And last but not the least, just a quick overview of our core team. And this is just like top 5, but if I look at a team or the wealth team of Bonanza as such, we are 75 plus people together serving the wealth industry and the portfolio management of Bonanza. So with that, again, I'm open to any questions that team will have, and thank you for the patient hearing. So Arvind and all the audience, we can take up the questions.
Thank you, sir. Thank you, sir. We must say this presentation is very informative, sir. Dear participants, the session is open for Q&A. You can post your questions in Q&A box. Sir, do you see any opportunities emerging from the global supply chain realignment and this China plus one strategy, sir? And tell us whether our Indian mid and small cap exporters are likely beneficiaries of it.
So I think that's an interesting thing, and China plus one has always been in our mind for almost a year now, and it has definitely huge benefit for India because developed economies, developed market has always looked India as a next alternate, and you see a lot of developments happening in that direction also. The classic example is iPhone, right? Apple. So another example is, I mean, in terms of sectors, if I talk about textiles, electronics, they have been the biggest beneficiaries, including the engineering goods. Right, so China plus one has definitely benefited India, and definitely along with India, there are other economies also. But speaking, to the context, yes, India has benefit, and it will continue to do so because of the opaqueness, in the Chinese government and policies. But China is a behemoth. See, it may be a temporary phenomena. You don't know when it will reverse. I always say that till the time is there, till the time India is a powerhouse, the way we are growing, benefited by PLI scheme and manufacturing. Yes, we have been a beneficiary, and we will be for next at least 5 years from now.
Got it, sir. So, what are some of the biggest structural shifts you are witnessing in Indian capital markets right now, sir?
So, structural shift, when we talk, one of the biggest structural shift is the participation of retail. And I'll give you two examples on that. The Demat account in India, they were roughly around 4.2 to 5 crore until 2020. And today, when we speak, it's close to 19 odd crores. So, we're talking about 5 times jumps in 5 years in the Demat account holder. 5 times growth. People are participating in capital market. Now, imagine, your participation increases, where this capital market will grow. I mean, when you just look at the numbers, they become mind-boggling. Another classic example is SIP flow. Now, as a retail SIP, we were doing around 7,000, 8,000 crore a month almost 4-5 years ago. Today, we all know SIP flow in India alone. Last month, I think in the month of May, it was 26,500 crore of SIP. You're talking about 4 times, 5 times growth in the SIP group. Now, this money will come where? It will come into the stock market, Indian market. Right? So, when you look at these kind of numbers, I always say it's a structural shift. And definitely, what has been the enabler here? The enabler has been the digitization. Right, the digital India, and I would say thanks to the phase we had in 2020, that focus impetus come on digitization, which has resulted onto this. So these are the two structural shift. I would say that's the retail participation, like anything. And one more thing that plays is the government policy and government focus. See, without government policy and focus, nothing will happen. And the kind of capex we are seeing, the kind of budget allocation we are seeing year on year on the budget, I think that's very encouraging.
Interesting, sir. With Bain Capital making a major investment in Manappuram Finance, how do you see this development reinforcing or validating your conviction in the company, sir? Especially with red strategy as an allocation in that company.
Yes. So as I was saying during my presentation, Manappuram Finance, we entered almost in the month of November 24, right? Okay. And when the gold prices were increasing, and we were very bullish on this gold financing, because with the increasing loan to value, household business will increase. Phenomenal business, and given the fundamentals and everything, we were more convinced on this idea. Now, Bain capital infusion of 4,000 plus crore and 18% stake is a conviction to the fact that they also see value. Definitely, it was not expected to that tune, that to 41.7% they will have stake post acquisition. But the money will be used for the growth and expansion of the company. So we have been holding it for a year now, and with this we foresee continue to hold. But like I said, the dynamics also change, Arvind, so there is a news, there is an element, there's an acquisition, there's a stake ownership change. So our thesis has been validated that yes, there's a business, but the synergies to kick in now. When any change happens, there's always it's a catch-22 situation. Will it go at the same pace, or the synergies will take time to kick in between management, employees, processes, thought processes? So that part is to be seen. On one side, it is good. Other side, as an investor, I have to see that do I have a better opportunity, so that time will tell. But as a business, yes, gold financing is a good business to be in.
Understood, sir. Dear participants, the stocks discussed in this session is not a recommendation by either Bonanza or PMS Bazaar. It's all for educational purpose.
Yes.
There is a prevailing view that small and mid-cap stocks are always overvalued, sir. So how do you able to consistently identify the value stocks in these segments, sir?
So my thought process, and when I talk to investors, I always say that, we always measure in terms of past, the P ratios, the PB ratios, some norms. I always say a growth company. See, so when you talk, are you a growth investor? Are you a value investor? I say, I don't know. I invest where my conviction is. Like I said, when you are investing into small cap and mid cap, it's not the comfort, it's the conviction. If you're talking about the India growth story, it's a conviction. So for me, valuations, yeah, if they're abnormally high, you look at 200, 300 P, market is giving. So first thing I will question is, why is market giving? I am not the only one who's seeing those ratios, right? There are investors, there are FIIs, there are DIs, and much smarter people than me in the market. So somewhere when the stock is trading at that, I may look at this opportunity that I'm missing, and these valuations may sustain for some time. And we have seen in past in many of the stocks. Right. So rather than the valuation, I would see, is there a growth? Can the growth sustain? Is this company doing something new? Is the innovation on track? If yes, I will continue to invest irrespective of the valuation. But making sure that I have my brakes which are functioning. That is a stop loss and exit policy. And the minute I see that red flags are there, I will exit. See, we always say, why do you have brakes? The brakes are there so that I can drive fast. So there are always pockets of growth. There are always pockets of opportunity in small cap and mid cap. Economy will be driven by them. So, but how and when to exit is what is more critical rather than the identification of the stock. And that's, I believe, is what we specialize in.
Perfect, sir. Sir, currently your Aegis strategy has, I think, substantial allocation to capital goods names. So how does this sector fit into your six-pillar strategy, and what is your outlook for this sector, sir, going forward?
So I think one of the slide I also showed on the capital goods, and I highlighted the FIs flow fortnightly, and capital goods was highlighted. So this is a sector that we identified in a very early trend. When we saw that FIs are continuously investing, it caught our attention. And we have some notable investments in our portfolios, right? We have ABB, we have 𝐿, we have Premier Energies. So again, when we are talking about Viksit Bharat, capital goods, you cannot ignore. So our strategies, this particular sector, I would say, is a top-down approach we have identified. And within identifying, after identifying the sector, there has been huge research to identify the next multi-baggers with a moat. So we foresee that this capital good as a sector will continue to perform for next 3 to 4 years. But again, the stocks which will perform, it will keep on changing. So we have to continuously eye for the new growth stories in this segment. But capital goods will be there, and the flows in this segment are testimony to the fact that developments are happening.
Fine, sir. Sir, is Bonanza's research approach purely fundamental, or do you also incorporate technical indicators, sir, in your decision making before entering a stock?
So when it comes to Edge, which is an opportunity portfolio, there's a special opportunities we find. It's a concentrated portfolio of 15 to 18 stocks, and we don't depend too much on technical, right? We are purely working on the fundamentals. See, fundamentals are basis, no denial, right? The technicals are only used to enter or exit. That is the only process of technical. But in Edge, we are primarily talking about the opportunities that exist in the stock, a catalytic event that will trigger and that will make that stock 5x, 10x, and I'll continue to stay put. No technicals used. When it comes to Aegis, I showed you 3 examples, right? Wherein we exited the stock at 30%. Maybe there was an opportunity loss. That is a strategy we follow in Aegis. So in Aegis, we exit on the basis of technicals, and we use technicals for sometimes, to enter. See, if we wait fundamentally to exit, my portfolio stock might have corrected by 50, 60%, and it's difficult to recover. So in actively managed strategies, I use technicals, and in Edge, we don't use technicals. And that's why I said one of the USPs that we have is a combination of strategies. That at an investor level, we try to merge 2 strategies to give a balance of growth as well as agility.
Fine, sir. Sir, if you're okay, we can go ahead with the audience questions, sir.
Yes. So, I'll just probably take up.
Yes, sir. You can take.
One of the question is talking about, so standard deviation is one thing. Mohanji is also asked best performance strategy and other strategies underperforming. So I think it's the perspective to whether they are underperforming or outperforming. So even these strategies, when we look at maybe edge, we look at ages in a year time frame, we will see that these strategies are underperforming. You look at a 3-year time frame, they are outperforming. You look at a 5-year time frame, they are definitely outperforming. So it's a reference point with which we compare. And one of the thing what I've observed is ki whenever the markets are down, we start to question. When the markets are up, we are all happy. But like I said, we have been there for 20 years and we understand all these things. So we are happy to take up any reference point and talk about it. So standard deviation we talk about. So one of the question is what is standard deviation, Kumarapanji? So it is basically the volatility, that how much stock fluctuates, and it also gives me a sense that how much downside can be there. So standard deviation is a statistical measure that we talk about.
I think he is asking about your portfolio standard deviation, sir.
So portfolio standard deviation would be around, for small cap, I would say it is around 26%. For mid cap, it would be around 19%. I'll share the data. If needed data, we'll definitely share that. So CAGR return has been asked by one of the this thing. What has been our CAGR return? So Satyanarayan ji, our CAGR returns for last 5 years has been 40% into mid and small cap, multi cap segment. In the large and mid, they have been close to 22% with the growth strategy. So that has been our CAGR return. So one of the return is, can you compare your returns with other PMS and relevant mutual funds? So with other PMS, definitely PMS Bazaar is a portal. You can definitely go and select multi-cap strategies. See, you have to compare apple to apple. So you can go to PMS Bazaar and select multi-cap and compare on different time frames. And when you talk about mutual funds, you can probably visit Value Research or Money Control and get an idea and sense of small cap. But just to give you perspective, in my presentation, I've shared the small cap index returns are 35% for last 5 years. And our portfolio returns at a multi-cap is 40%. Multi-cap means I have a mixture of mid-cap and large cap also. So definitely, if I look from that perspective, there is a 3 to 4% alpha over mutual funds compounded over last 5 years. So that is there.
Akhil is asking one question. What valuation would you call as reasonable when it comes to PE of mid and small cap compared to large caps?
If you ask me honestly, like I said earlier also, I personally don't give too much weightage on PE unless it is above 150 or 100. I am okay to buy the stocks even at 80 PE. But yes, I will be willing to give that PE for a growth to a mid cap and small cap. When it comes to large cap, again, maybe putting it 40, 50 PE, if I'm buying anything above that, I will revalidate my thesis if I'm entering that. But up to 30, 40 PE, I'm comfortable. Beyond that, I have to really look into large cap if I'm really entering with that PE. With small cap, I'm comfortable with 70, 80 also. Because like I said, the growth stories will shape up over a period of time. They are trying to solve some issues. So PE is not really a strong matrix for me. For red alert, yes, if the PE is above 100, 120, I will look at it. But apart from PE, there are EV by beta and other metrics that we may give more importance rather than PE alone. So one of the question is there, and it's a very interesting question. I would like to answer this. So being for more than 10 years, why the AUM is not significantly higher? So I think this is a question I am always asked, and I take proud in telling that why it has not and what is the growth story today. Bonanza has been doing PMS for 20 years now, not 10 years. We were among the early drivers. In 2003, we got our license as a PMS. And like I said, essentially as a broking firm, we were giving PMS services to only our broking clients, right? Until 2018, our only focus was on the broking clients. And even to date, I have clients who have invested 5 lakh rupees with us in that time. We were a relationship driven firm, right? 2018, until 2018, if you will see our strategies are growth and value, which were the driving themes in 2010 and 11. That was the investment charm, that whether you are a growth investor, you are a value investor, and that is where the name comes. 2018 fall when happened, we realized that the traditional way of investment is not going to work. Clients will lose portfolios like anything, and portfolios got eroded by 40 to 50% into small cap and mid cap in 18 fall. That's where we changed our whole process. And we really worked upon transitioning from traditional long only to having a stop loss, having more system driven approach. Result was when the COVID came, our portfolios did not fall by more than 15-20% compared to market fall by more than 50-60%. And those who are interested, I can share the data. As of 30th or 31st March 2020, our fall compared to the market fall. Right? When we realized that the changes we have implemented are good, we ramped up our scale and everything. And 2021-22 is effectively when we stepped out of our Bonanza network and started targeting investors. Right. So our growth story is merely 3 years. And again, to put it on record, we were merely 50 crores 2 years ago. And as I speak today, we are 350 crores. And we will be 1,000 crore plus in a year's time. So I'm very confident with our processes, with the way we are going. But yes, for the AUM being low, it has been our approach to our investors. And we have started going out to the market 2 years ago only. So I hope probably that also clarifies our stand on that.
Sir, Kumarapan is asking, what is your churn ratio typically in a portfolio, sir?
So in Edge, like I said, it's a special opportunity portfolio. Our churn ratio is very low. We will be buying and waiting for the opportunity. So, mostly it would be probably 1.5 maximum, once we have bought any stock, maybe 20% churning may happen. When you talk about ages, it can be high, it can be up to 2.5 to 3 as well, because like I said, in the volatile market, it becomes high. And in the non-volatile market, it is little low. So it's actually a function of volatility, because in the month of Jan to March, we had to exit many stocks because of 30% drawdowns. And we did. So during this last 6 months, 7 months, it has become higher. But at the same time, if you look from April 24 to September 24, our churn ratio was very less. In fact, we were one of the top performing scheme in the month of, I think, December sometime. So it's a function of volatility, essentially.
It's a question.
And one more thing, Arvind.
Yes, sir.
Churn ratio, understand one thing. Any portfolio manager will not be churning because they want to churn. There is a reason that churn happens. Either I want to book profit, either I want to have a stop loss and make sure that portfolio does not erode well. I am seeing some changes in macro, then I want to come in cash. So rather than churn ratio, I suggest to my investor that look at the net returns. That churning is not happening because anyone, not only me, they want to churn. That is not the case with anyone. The churning is happening because of the process or the strategy that a particular fund manager has, is working with.
There is a question on, do you service NRI clients as well, sir?
Yes, we service NRI clients. We have also onboarded clients from, US and Middle East. So yes, we are onboarding NRI clients.
I think we are done, sir. Remaining questions, I will send it to your team, sir, so that your team can answer.
Yes. So again, I would like to thank your team, Arvind, PMS Bazaar team, and all the investors for their precious time. And I hope I've been able to add some value, for the time that you have invested with us. Thank you. Thank you, everyone.
Sure, sir. Thank you, sir, for your insightful presentation. Thank you all for attending the webinar. Thank you.